Hey everyone, welcome back to Yuri's Box. In this video, I'm going to look at a variety of different indicators that got released today on the state of the US consumer and US businesses. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So today we got the Conference Board Consumer Index. We got the Richmond FED Manufacturing Index and the Philly Fed's non-manufacturing index. I think I'm not forgetting anything else, but in any case, we'll start off from the Richmond Fed manufacturing report, and so really it is just painting a picture that is quite similar to what we saw in the March PMI that I looked at yesterday. So really, what did we see yesterday? Overall, businesses are reporting more of the same of what they saw in February. The outlook has dimmed, and we still have things like tariffs and incoming policies from the new administration that are creating some uncertainty. Okay. Now, as far as the Richmond Fed is concerned, what they've highlighted is that again, manufacturing activity slowed in March, and they have their own indexes falling significantly from the previous reads. At the same time, you do what gets highlighted on the inflation side of the story is that yes, prices are on the rise. Okay, now as far as my personal bias is concerned, I've made this quite clear in my previous videos. It's not that I think that inflation doesn't have a role in this in 2025. It's just a matter of asking the question, who do you think is most likely going to eat or have to chew the price increases? Okay, because you really have two possible paths. Either the consumer is in great shape and has the tools to fight against the price increases, so namely higher wages, and so therefore companies can pass on those costs to consumers, and so inflation will potentially rear its ugly head again. Or it's going to be businesses, because businesses again, they really have two ways of protecting margins when import prices increase. They can either pass them on to consumers, but that is banking on the fact that consumers will actually accept the higher prices. So again, that is again banking on the fact that the businesses have pricing power. And if they can't pass on those prices on to consumers, the only tool that is left really is layoffs. So that is how you get this kind of perverse loop where inflation, instead of leading to further inflation, it leads to disinflation. Okay, and it's really just a matter of what you think. I've made my thoughts clear. I think that just looking at a variety of indicators such as like the quits rate, for example, that gives you a lot of insight onto what people are really feeling. Putting aside politics and everything else. So back to the reports, really more of the same on the Richmond report, really. Activity, at least on the manufacturing side of things, slowed somewhat, and prices are going up. One thing I want to highlight before I move any further, the way you usually see these reports, the way they talked about is that whatever narrative someone wants to push on the internet, it's just kind of cherry picking. Okay, if this regional index is telling me that inflation is going back up, then I'll look at this regional report. If it doesn't confirm my narrative, I won't look at it. That is basically how these reports are treated, because again, they're not really indicative of the national level. They are looking at particular regions of the US. Okay, so Richmond, and again, moving on, we had the Philadelphia Fed non-manufacturing business survey come out, which was another index that came out today. And really, again, more of the same. If you remember what I went over on the PMI report, it's just activity is still on the same note as it was in February, and you have price pressures. Okay, now what does the report itself say? Okay, so indexes for general activity, new orders remain negative, with the former declining further. On balance, the firms report a decrease in full-time employment. The respondents expect decline in growth overall over the next 6 months, both for their firms and in the region. Employment index fell 10 points to negative 7.5, first negative read since August. And on the inflation side of things, you have price indicators suggest increase in prices for inputs and the firm's own goods and services overall. The future general activity indexes suggest that respondents expect the continued declines in activity overall over the next 6 months, with both series falling to the lowest reading since April 2020. So you're really seeing the worst of both worlds here, because again, you see the growth side deteriorating, and you see the inflation side potentially rearing its ugly head once again. Although, as I said previously, inflation being a problem at a time where growth is suffering will likely act as fuel for the growth, for growth suffering, okay, as I've pointed out in my previous videos. But again, that's just my opinion, and I could very easily be wrong. Again, we'll just have to wait and see really what the picture looks like in the coming months. As I said many times, I think this is a developing story, and I think it would be unwise to just take 1 month's data and just assign a narrative to it. Just it's a matter of looking at the trend and trying to see the direction. As I've said before, my general understanding of the situation, again, I could very easily be wrong, is that we're in a slowdown. Are we in a depression? No, absolutely not. Are we booming? No, we're slowing down. And that leaves room for negative shocks, okay? So overall, the non-manufacturing side of things in the Philadelphia Fed report really dipped below basically where are we here? The last time we saw these levels were really just post-pandemic. Again, I think here it said something like April 2020. And again, you can't really read too much into these reports, again, because they're looking at specific regions of the US. Although, if you put 2 and 2 together, you can kind of get a more general idea of how things are going, given the fact that we just read the Richmond Fed come out higher than expectations, but really just declining since its previous read. We can also give a quick look at the at last week's release. I waited a bit before looking at the manufacturing, so that I could look at manufacturing and non-manufacturing. This got released on March 20th, if I'm not mistaken. But again, more of the same. Okay, you could really summarize my videos in a few words: more of the same, because this is really what we've been seeing ever since the start of the year. Manufacturing activity in the region expanded overall, but was less widespread. A higher share of firms reported a decrease in production compared with the share of companies reporting an increase in production. On the inflation side, you saw prices paid index increase 8 points, with over 48% of firms reported increase in input prices, while none reported decreases. 48% of the firms reported no change. Okay. Going back to the growth side of things, the future new orders index dropped 31 points to 2.3, the lowest reading since May 2023. And the shipments index fell 25 points, its lowest reading since June. The firms continue to expect an overall increase in employment, but the future employment index declined from 23.7 to 17.3. Overall, the survey's broad indicators for future activity suggest less widespread expectations for growth over the next 6 months. Again, more of the same. We're really not seeing anything that dismisses what we saw in the February PMI report. Really, personally, I'm still looking for reasons to, cast aside my bearish bias. Okay, because again, if I'm personally, I guess I said bullish something like bonds, and again, the only reason why you'd be bullish bonds is you're extremely optimistic about inflation, or you're extremely pessimistic about growth. I tend to lean more on the side that I'm more pessimistic about growth, and I'm still looking for reasons to kind of cast those worries aside. And so far, I haven't found any. These reports really are just small clues that continue to add pieces to what we saw really in February. And again, going back to something I've been pointing out ever since my very first videos is that I actually have it already open here. Is that just looking at headline inflation? Whenever you see, from fall to more or less January to March, and looking at this cycle, this is exactly what we saw last year. Last fall, we saw inflation kind of bottom out at around, 3.2, 3.1, and it actually, peaked again in March. And again, the rationale behind that is that time frame is when you have the holiday season. It's when people travel more, people, spend more on gifts, people receive end of year bonuses, and people are generally feeling better about everything. It's the holidays. Who doesn't feel better during the holidays, okay? On a generally speaking. So it wouldn't be surprising to see inflation be sticky around that time. We saw something very similar occur this year. Now we're still waiting for the next inflation print, which really comes in about 2-3 weeks. But again, this year we had these structural events, the holidays, namely, be aggravated by things that occurred that weren't really structural. So port strike fears in September, natural disasters in October and January, and tariff front running most of all. Okay, so a lot of the inflation that you're seeing right now, and potentially some of the growth outlook that you're seeing right now, the growth and activity increase that you saw from September to January, could be interpreted as simple tariff front running. Okay, and what I'm personally waiting for is a reason to dismiss the slowdown thesis. Okay, and again, just going back to what we were reading here, I still haven't found it, and this is just my personal opinion. I'll leave. You come up with with whatever you think, and again, it's just a matter of waiting and seeing the data come out. Now, we actually had another index get released, and that was the Conference Board's consumer confidence, and we saw that tumble to really low, not seen since really more or less February of 2021. something like that, the beginning of 2021 anyway, which was a big decline, even in the context of history. And so really this index is really divided into two. If you read the report, you'll see it has present situation index and the expectations index. So present situation, as you know, the title can lead you to believe, is a representation of current conditions. The expectations index is really a representation of the expectations of the future. Okay, and what really declined was the expectations index. So consumer and businesses outlook for the future. Okay, dropped 9.6 points to 65.2. Well below the threshold of 80. So whenever it's below 80, that signals bad times ahead, and whenever it's above, well, you can sleep soundly at night. The present situation, although it decreased, it didn't see anything too dramatic like the expectations index. As the senior economist here says, consumer confidence declined for a fourth consecutive month in March, falling below the relatively narrow range that had prevailed since 2022. Of the index's 5 components, only consumers' assessment of present labor market conditions improved, albeit slightly. Views of current business conditions weakened to close to neutral. Let's see what else is here. Consumer confidence expectations were especially gloomy. And again, just looking at the two different indexes right here. Okay, right here, consumer assessment of current conditions was significantly less positive in March. Okay, so present conditions really didn't move that much. Okay, you can see here, consumers said business conditions were good, down from 19.1% in February. Nothing too dramatic. Again, as I was saying before. 16.6 said business conditions were bad, up from 14.6. Granted, a move, but nothing dramatic again. Same thing here, views of the labor market improved slightly, but again, the number of people saying jobs were plentiful were unchanged from February. And the share of people that said that jobs were hard to get were really flat. I mean, we had a 0.3 decrease from February, which is, hardly a decrease. So present situation really hasn't changed that much. It's decreased, it's worsened, but not by a whole lot. Where you really saw the decrease was in the future expectations. So what I really like to pay attention to is the labor market. Okay, as again, just taking the view of the looking through the lens rather of the of something like the quits rate. Okay, and the reason why, because it goes hand in hand. Again, labor market outlook: 16.7% of consumers expected more jobs to be available, down from 18.8%. 28.5% anticipated fewer jobs, up from 26.6%. Income prospects were down from February, 16.3 against 18.8, and 15.5 expected their income to decrease, up from 12.8 in February. And again, the reason why the quits rate and outlook for the labor market go hand in hand is because, again, what is the quits rate measuring? It is measuring how many, the rate at which people are leaving their job voluntarily. And the only reason why you think, you'll leave your job voluntarily is if you think you can find a better job. Okay? If you see abundance in the economy. And if you don't see abundance in the economy, as the this part of the survey is suggesting, well, then you're not going to quit your job, and you're not going to have that positive, feedback loop, to get a higher wage, potentially leading to, inflation being less of a less of a problem really, and more of a problem on the growth side of things. Okay, again, really, I want to be clear. It's not that I think that inflation doesn't have a role to play. I want to be really clear about that. And I'm not even suggesting that it isn't causing problems. Of course, it's causing problems. The problem is that if consumers can't bear the costs, then it's going to fall on businesses. And if businesses, again, can't pass on those costs to consumers, the only tool they have at their disposal to fight against the price increases is cut costs. Okay, and that is anti-growth. That'll it'll cause layoffs. Mainly layoffs, and layoffs are by definition a killer for growth. And if growth declines significantly, well, I mean, recessions are probably the best thing you have at your disposal to fight inflation. Again, you're burning down the house to get rid of termites. That's kind of the picture. But again, if we are to see a significant more slowing in the economy, inflation is just going to add fuel to that narrative, in my opinion, rather than be a story. I mean, of higher prices and people having to deal with higher prices. I just think that given where we are, higher prices will just lead people to reject them altogether. But again, we definitely had the only thing we can do really is wait and see how the data comes out. So far, we still haven't really dismissed that thesis, and we're nearly in April. It's nearly April, and so far we only had a confirmation that we're moving back towards what we saw last summer, with the added negatives really that we have tariffs, and I went over that in yesterday's video. We have fiscal tightening, nothing too dramatic really compared to what was announced at least at the beginning of the administration. And as long as those things at the economic level continue to make themselves felt on the economy, those will act as headwinds to growth. And on top of that, there are signs that we no longer have the stimulus from the pandemic era, in the shape of state and local government spending that again falls back into the fiscal tightening picture. And we also are lacking some kind of stimulus. Okay, so it is also a problem with sequencing, because if we had something like tax cuts get announced first, okay, as many people were predicting at the beginning of the year, we'll have tax cuts, all the growth positives, and then we'll deal with the growth negatives such as tariffs. That stimulus would have acted as a shock absorber for the negatives. We're really acting without shock absorbers, and that's potentially another reason why you should be wary of growth at this point. But again, things can change from one day to the other. Just look at the tariff side of the story. Last month, it was tariffs galore, and this week it's we'll see what we'll do with tariffs. Okay. Overall, whatever the outcome with tariffs, it's going to cause pain in the short term, and again, that is negative for growth. If you want to further insight, at least of what I'm thinking of, how I'm thinking about tariffs, you can watch
the video I made yesterday on again on tariffs. So overall, we had Richmond Fed, Philly Fed, and the Consumer Confidence Board indexes released, and it wasn't a pretty picture. All right, we have activity slowing, prices going up. In the short term, this could easily be painted as a stagflationary environment, although at this point, with growth slowing, this at least is my opinion, as growth slows, inflation will just act as, well, put more of a brake on growth again. It all comes down really to who is going to chew and stomach the price increases. Is it going to be consumers? And if it's going to be consumers, then the consumer is in much better shape than at least I'm thinking. And if it isn't consumers, it's going to be businesses. And if it is going to be businesses, that will come in the shape of potentially layoffs, which is anti-growth. So again, what can we do? We can wait. The most boring thing and probably what happens in finance, a lot of finance is just waiting in my experience. um so again, we do have some extra data points coming out. I think that the most important data set to come out this week was the PMI, because I was really looking for any hint that perhaps what we saw in February was just a one-off, but we saw more of the same. Just like as we saw in today's video, the Richmond Fed is pointing towards a similar direction. Philly Fed, both on manufacturing and services side, is pointing in the same direction, and also the consumer confidence index is pointing in the same direction. Now, next week we do have the non-farm payroll report come out. I don't think we have estimates yet. I think it's still too early. We'll get them probably on Friday. Trading Economics puts as a forecast for 80K. I'd wait because I think it'll be slightly higher. The at least what the Wall Street is expecting. We also have another initial jobless claims number come out on not this one here. We'll go back to this week. Right here, estimated at 225. Again, I'm starting to get a clearer picture of what to expect on the non-farm payroll report. For the added jobs. And I'd still wait for another round of initial jobless claims just to get a clearer picture of what to expect on the unemployment rate side of the story. Overall, today's data was really negative. That is being reflected in things like TLT. TLT yesterday got quite a beating, as you'd expect. Really, the PMIs, at least on the services side of things, came out better than expected, at least on the headline anyway, and that helped push the price higher. I wouldn't, I wouldn't really be worried about this. As again, as if you read the reports, what the reports are telling you is that it's more of the same. We still have not dismissed what we saw in February, okay, and it's just another month where we saw more of the same. And the only thing you can do is just really wait for the incoming data. Potentially, I wouldn't be surprised if we do, again, as we just actually did today, pop over the bull market support band. Now that I notice, I wouldn't read too much into it, unless that is of course we get a blowout number on March. Then you could definitely see things move back up, say, to the 480 on the 30-year. But given where the reports are so far, I'd still lean on the
nothing too dramatic side of things as I was in February. Um, so probably a miss, but something between 100 and 150. That's my general feeling about the numbers. But again, I'll let you know whatever number I come up with in the near future. I'll leave it at that. Continue to keep an eye out for these reports, as they can add small pieces to the puzzle. So again, if you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. And I'll see you next time. Bye.